All right, guys, good afternoon. And how's everybody doing? It's officially into the second half of tax season. I see Adam on here. I think you're here, Adam, right? Don't forget to pop that microphone on if you see that button at the top of the module there. Just say hello to everybody to get us started here.
Hey, Andy, can you hear me?
I can hear you great. How you doing today?
All right, how about you?
Yeah, pretty good, pretty good. I thought we'd start, you guys, by just talking about something that I think Adam and I always kind of joke about, going back and forth. And, when you're trying to do something like build up your business, help your clients and things like that, obviously, which are very important. Sometimes, we can have the potential to get a little bit overworked, I would say. And it's kind of a challenge, especially just with tax season. All the jokes about not seeing your family for for months and things like that. And I just wanted to see from you, Adam. Like I know, you have kids, you have a family, but you also have a thriving business. How do you, for our members that are kind of in that same zone as you, how do you start to maintain some of that work-life balance even during tax season?
Um, just I don't know, trying to be mindful of it. I, I don't know. To me personally, I probably make a lot of personal sacrifices, meaning my sleep or my personal time to make sure that I still make time for my family. Um, my boys are 6 and 9, and I coach both their recreational baseball teams, and so tax season's not the best time for that. But I still manage to. I mean, we're probably up at the ballpark for 5 weeknights of the week here starting March 15th. So I still figure out ways to work. I just try to stay very effective and focused when I'm working. We have a cloud-based infrastructure, which makes it pretty easy to access anytime, anywhere. So a lot of times it sort of feels weird to my staff, I think, when they first start here, because I'll get in early, but I may cut out at like 4:30, 5 o'clock on the dot, spend some time with my family, eat dinner with my wife, and then go back at it later in the evening. So that's kind of what I guess right now some work-life balance stuff looks like. But I think a big thing too is like always asking yourself if you should be doing the work you're doing, or if there's someone else that can help you with it, or if you have other team members, if there's better things to do. And kind of as I coach my team members along and develop more leadership here at my firm, it's like always coaching people on that as well. Like, is this the best use of your time? Because you certainly don't need to add time sucks to a time period where you already are short on time.
Yeah, that's for sure. And maybe you guys can let me know too. I mean, we just kind of making this overall point to, maybe you do cut out a lot of things when you're really in this building your business mode, but, whether it's Adam finding time to coach his kids' games or, what's important to you guys? Like, what do you really enjoy doing, outside of work, and just making sure that you're being conscious of doing that because ultimately life is short, and I think it's really important for us to keep that in mind. I know for myself it's always a struggle, but are you guys hearing us okay? I'm not seeing too much chat action, hellos, where are you from, that kind of stuff. Let us know if you can hear me.
And Andy, it gets really frustrating to me when I'm say out at a baseball game or out doing something or out having dinner with my family, and people are like, "Whoa, I didn't think you could just like I thought you were chained to your desk." I don't know. It's sort of aggravates me that people like expect and think that I should have no life.
Yeah, it's one of those assumptions things. So I mean, when people have assumptions about us as actual grown men, actual grown human beings, that we actually don't have to fit into the stereotypes that people have. But I know what you mean. It's kind of that. Just as a business owner, it's like you work so hard to be able to have those times, where you do have that time freedom. And so I know what you mean. It kind of can can grate on you a little bit. But that's kind of what my warm and fuzzy, message for you guys. And I know it's something that Adam's always, balancing as his team and business has continued to grow. So I just want to make sure you guys are kind of keeping that in mind. And now we got the warm and fuzzy out of the stuff out of the way. Let's talk about making money. So the one thing that was, and obviously those things hopefully will go together for us, right? As entrepreneurs, as career focused people. But you had mentioned, Adam, in our brainstorm for this training, something that you said you were anticipating a significant amount of revenue. I think you said like ten or $20,000 in a week. From something called ACA ISRP 2016/17 amendments. And I just put 3 question marks there because I don't know what that means.
You don't know what it means. All right, so I'll try not to get too in the weeds to this. And I don't know if, Andy, if you've ever done any continuing education with Don Farmer. He's actually here in North Carolina, but he does a lot of tax. He does a great tax update CPE. And he also has a tax newsletter where he basically just kind of monitors things and then kind of breaks it down pretty helpfully into action items or planning points or things. And in his most recent one, he sent out, I don't know, a week or 2 ago, just touching about, okay, here in 2018, with shared responsibility payments, so that the tax that they hit taxpayers with on their tax return for not having health insurance during the year.
Mm-hmm.
Basically, highlighted in 2018, if the county you live in only had one one company of health insurance available on the exchange, then you're exempt from that tax and you can claim an exemption and not be penalized for not having health insurance. And you don't have to do anything special in 2018 to claim that exemption. But he also highlighted that in 16 and 17, this was not the case, but that you could retroactively go back and amend tax returns to basically claim back the tax penalty that people had for not having health insurance, as long as your county was the county they lived in was a county that only had one type of health insurance on the exchange. And so in our area and most of our clients that I've looked at, not just the ones in this area, but also ones around the nation, seems like pretty much it's 17 and not as much a 16 issue. But so I ran a report in Dre, pulled those returns that had the penalty for 2017. And I think the total penalty on our tax client base was like $77,000. So that's the total amount of amendments, that money that could have gotten back via amendments. And we had basically $55,000 worth of that refunds as people have signed up for us to do amendments for. And it looks like it's going to be $12,775 worth of revenue that we invoiced today for that work, and we basically told them they need to pay by tomorrow in order to do that. So we'll see if they actually do that. But
nice. I like the salesmanship.
And so what we have to do with that 2017 stuff, though, is it's not that bad to do the amendments. What we have to do, though, is we have to actually apply for an Affordable Care exemption, get them to sign that, send that in, get that exemption number, then submit that with their amendment. So there's going to be a lot of administrative stuff with it. It looks like so far $3,925 worth of that has been paid so far today.
That's a good percentage.
For what we invoiced, I think, here this morning. So we're working through that process and basically, helping people. We have, we have 2 clients that have over $11,000 worth of refunds coming back to them.
Nice. Yeah. So as you guys have found in the program, we really, Adam and I really see eye to eye on the, on the client value side and making sure you're looking for those opportunities to apply your training, apply your education, and really make a difference. So maybe some of you guys have the same ability to pull the same report out of your own software. I know that's not something that's directly, business tax related, but realistically, a lot of business owners are the ones that are paying that penalty or have paid it. And so certainly the ability to get back that penalty and as well as acquiring some new revenue for yourself, hopefully that's helpful to you. So thanks a lot for sharing that, Adam. That's really cool.
Yeah, and it wasn't directly business related, but I thought it was too good not to include here today.
Yeah, definitely appreciate it.
Yep, and I'm kind of like, now I'm thinking about that beyond this, but like as a marketing tool for like people and getting that messaging out. So, and my brain's going. I don't know that I'll tackle the rest of that marketing reach out here during busy season, but I did want to get the ball rolling for at least our existing clients.
Yeah, absolutely. So I guess the report would be something like, people who paid the penalty, and then also their city report or something. And
yeah, there's a I'll put it in the. I'll find it, put it in the notes. There's a website out there that lets you see by year, by county, whether you had how many health insurance providers you had for this purpose.
Very cool. So I want to keep it moving, you guys. I try to prepare some visuals for you guys here on the screen here. Just so as we go through the questions, you have something to kind of look at if you're watching it on desktop or on mobile. So Gaynell Hunt, one of our best members, had a good question in the Facebook group that I did some further research on. I wanted to make sure we got him a full answer on that. And this is something that, I'm sure you see some too, Adam, with, realistically, a lot of newer business owners or Schedule C business owners, like Gaynell was pointing out here, they really don't track inventory, in any sort of reliable way. Would you say that that's a fair statement in some cases?
In some cases, yeah, unfortunately, but yeah, in some cases, it's the way it is.
Yeah, and so it comes, when you have this part 3 of the Schedule C, right? This is a part of the form that definitely confuses a lot of people, and I've been among that group, before I did this program and studied under Adam. But so let me kind of just touch on a couple research points that I put together. Here's the instructions, you guys, to is that the instructions to the Schedule C? Yeah, that's the Schedule C instructions. If you guys want to, or maybe I can pop that into the chat for you guys. But the bottom line is for this, for cost of goods sold, they actually do allow an exception for small business taxpayers, and this is screenshotted directly from the publication, you guys, where it actually can choose to not keep an inventory, but still must use a method of accounting for inventory that clearly reflects income. What does that mean for you, Adam? And I know you guys do deal with some clients that have inventory. How do you kind of look at dealing with that issue?
Yeah, I mean, we do encourage, and we don't do a ton of we don't do a lot of retail stuff or things where people necessarily have inventory. I'd say more of where we do. We deal with larger e-commerce companies that maybe have their inventory with Amazon, so it's a little easier. They're forced to track it.
Okay.
But really do encourage them to keep inventory. But I know for some small and mom and pop shops, that's hard to do. Or if they're sitting down with you in April and you say, well, I need to know your inventory for December 31st of 2018. Well, if they didn't do it at that time, there's no way for them to get at it. So it's, you just got to make sure that you're trying to keep it as tight as you can with that. But I don't know. Generally, we will try to get to the best method for the current year, and then tell them, really from a best practice perspective that they should be tracking it. But I don't know if you have a different way of normally handling that, Andy, or not.
Yeah, I mean, when I had done the research here, based on, I wanted to make sure we got a full answer for Gaynell. My reading of it is, especially if it's a smaller business, you can write off all the purchases in the current year if you're checking that cash accounting box on the Schedule C. But I think it's just, it's one of these things where we have to keep in mind the tax impact, and also keep in mind the the fact that there has to be some kind of consistent method. Like if somebody writes off all the purchases in 1 year, they're not going to have that expense in the next year. So does that make sense for them? Does that is that what long term they want to be doing? What's the communication there between you and the client? So if we're not talking about large dollar figures, like for instance, I'm not sure if Gainell's on the call today, but we had a client that is doing a startup business right now, and he spent like $14,000 acquiring his initial inventory. And he's actually leaving a very high income W-2. So his income probably will be less. His tax rate probably will be less in future years. So it's kind of tempting to write off all the purchases in the first year. But then again, he's trying to grow a bigger company. So I think just being wise, and kind of measuring that out, also focusing on the communication with the client. But I think especially for the smaller businesses, it's not if they haven't kept inventory. I mean, this is screenshotted from the IRS, publication. So you have the option to not track inventory, so it's not like, you're the worst person in the world, or, it's so just, hopefully that's helpful to you guys. On also had a good question, Adam, which I was hoping to get a comment on. I love the introduction of the question. I'm an amateur, and then she has like a very sophisticated, smart. So like, we're on to you on. We know you're smart, but need to make journal entries for a court dissolution. So I think the court dissolution, that is something that's a little bit tricky and kind of. Have you guys dealt with many of those, or what kind of thoughts could you share on that?
Yeah, I mean, I guess maybe the underlying question here is like zeroing out the balance sheet for the year end and things along those lines, or the end of the business. I don't. Can you scroll up a little bit there, Andy? Just a second. I don't know. I can't think off the top of my head that I'm or understand what she's looking for there with the realization account in QuickBooks. Do you zero out the balance sheet? I mean, typically we will, but you sometimes run into scenarios where the business in essence is shut down as of December 31st, 2018, but as of here February 28, 2019, they may still have $500 in their bank account, and kind of sorting through that issue and all right, how do you treat that? As the business still open? Is the business still closed? And in general, in most cases, we'll try to mark that 2018 return as a final return and zero out the balance sheet. I think the biggest thing with the balance sheet or zeroing that out is like figuring out if they have assets, where those assets have gone, have they been sold, have they been distributed, or what's happening with them, how to handle them properly on things.
Yeah, and I think that's kind of On's point about the realization account, is to like, what am I writing the journal entries against? And I think thinking through the assets and where did those assets go, is kind of gonna lead her in the right direction, in my humble opinion. So I wonder though, like with shutting down a business, I guess we've all seen by this point, things where when businesses are not properly shut down, a lot of problems can continue to happen, and just kind of a negative thing. Obviously, if somebody has a business that failed or something like that, and now it's more problems, it's, you do feel bad for the client. I wonder, is closing down a business properly something that like you guys see a demand for that service? Is there value there for us as providers?
I don't know. We haven't capitalized on it too much. I mean, usually it depends like what the situation is where they're closing down. If they're approaching bankruptcy or something else, they may have discussions with us beforehand, or having debt canceled. Hopefully they're having conversations with you so that they understand the tax implications of that. I don't know. We don't see a ton where they're shutting down, unless more where we see them shutting down is like, all right, they're a schedule, they're a smaller business, they're Schedule C. You don't really have to worry about, the implications too much of having a balance sheet and other things there. So.
Yeah. And On had a follow-up question. Keep in mind too with these live Q&As, you guys, that Adam's actually a brave soul to get up here and take all these. We got a timber question coming up next, so,
Okay.
so keep in mind.
No,
Yeah, we
I'll see what I
never
can do.
profess to know everything. Believe it or not, Adam doesn't know absolutely everything off the top of his head. So, but On had a good follow-up question here. Is the nominal realization account any kind of account you make up? It's a kind of clearing account. So it sounded like maybe you hadn't seen that type of account, or does that ring a bell with you?
Um, haven't read, not that I can think of. I mean, a lot of times it's just reflecting, say there's a vehicle in the business and they're keeping that vehicle personally going out is like, distributing that vehicle off the books. I guess you can have, depending on how it is, you could have gains or losses based upon that scenario. But in most cases, when we're taking assets off the book at when the business is shutting down in general, we're trying to do it at the current book value and not trying to trigger a gain or a loss there at that point in time. But it just, each situation is going to be a little bit different depending on the facts and the circumstances.
Yeah, and I think that is the point that On's getting at there. That realization account may be some form of distributing some kind of account that's being for lack of a better phrase, made up to account for a distribution of assets. So again, maybe too, On, you might want to post a couple screenshots. Obviously, black out any sensitive info, but about a specific situation, and maybe we could kind of address that more in the Facebook group. But I did want to make sure we touched on it. Debbie had another one of her smart people questions about the sold timber off 80 acres. I didn't grow up around too many timber farms myself, so I was kind of like, I wasn't sure what to say about this one. But I did notice that, the acreage was gifted in 2006. I have been seeing, Adam, in our business, more and more like inheritance and estate. And, there's this whole kind of, generational shift of wealth that's happening. Trusts, estates, and gifts and basis. Have you guys been seeing some of that pick up in your work?
Yeah, a little bit, or just trying to figure out, or the more interesting ones is you have someone, with a business and they're like, I think I wanted this to continue with my son as my succession plan, but I'm not sure he can handle it, or they go the other route, where they're like, I think I want to sell my business because my son or daughter is not ready for this. And then they end up not getting, and then they end up still just kind of holding on to the business and making some improvements because they're potentially positioning it for sale. But, I see a lot of just indecision some in these areas because, when it comes to family and when it comes to money, if there are tough decisions to make, sometimes it's tough to come to that conclusion or determine what you want to do. So it's an interesting area. And then, just pertaining to, I think there's been a little bit the last couple years, there's been so much uncertainty related to estate tax and everything else that people are kind of stuck in inertia and not moving. But I think now where there's at least some clarity through at least, 2025 or 2026, that maybe people are starting to take some action.
Yeah, and with so much asset appreciation, especially say in some place like California, you have properties that were bought for, for 200,000 that are now worth 4 million, and so, when is, if that's left as inheritance, it's non-taxable. However, if it's given as a gift, the basis is totally different, when the person goes to sell it. So I definitely think it's something to look out for, and that's a little bit of what we see here in Debbie's situation. I would say, Debbie, that to look up, I put this link here, basis of gift, and you can Google search that too. And so that the basis of a gift is going to be a very specific and kind of confusing way that IRS puts it. So I'll share that with you here in a second. you guys can see that. This is the page, and there's a few different rules as far as if the fair market value of the property at the time of the gift is less than the donor's adjusted basis. So they actually do a pretty good job of briefly explaining on this page how you would figure the basis, which I think is kind of the core of your question here. So I would look at that page first of all, and then secondly, and let me know what you think about this, Adam, is I think for the part about reporting it on Schedule D versus Schedule F, right, would be the business. So are they in the business of timber farming? Like, is that their business? Is this some kind of like a business sale, or is it more like a piece of land that was never, it sounds though like it's a business, like that's what they sell. Yeah. They sell timber, right? So that to me would preclude, being able to report it as a regular capital asset sale. Would you kind of agree with that?
Yeah, I mean, it sounds, and I don't deal much or really with timber farming much at all, but I would agree with your general premise that if it's in the business of doing something, it's most likely going to be reported on that specialized form, Schedule F, or whatever appropriate form it is, more likely than the Schedule D for like the sale of a personal capital asset or something like that.
Yeah, so hopefully that is helpful. Again, it's not a specialty area for either of us, but just some things to think about. I would definitely check out the basis of the gift and maybe even dig into a little bit more about what was the nature of that gift. How was that documented? Sometimes people think it's a gift between family, but the attorney handled it differently than that. So I think you got a little bit of work to do here. And I guess for these type of specialty situations, I would just say too, like, don't be afraid to team up with somebody that specializes in this field. And on that note, I know Adam, was looking for a connection to one of our members who specializes, one of our business tax verified members who specializes in hurricane disaster tax implications with all the fires in California last year. That might be something that you guys are seeing. Can you talk to us for a second, Adam, about working cooperatively with other specialists and kind of maintaining a good relationship with other professionals?
Yeah, some people it may seem counterintuitive, like, hey, why should I talk with and you can't see my air quotes, but competitor about things. But yeah, it's good. You're never gonna know everything. You're certainly not going to be able to specialize in everything, and so when you get into situations like, or see situations or need to help clients in situations that you haven't seen, it's good to be able to, talk with and or engage other people that have had experience in that area, so that you make sure, one, you're doing your due diligence and doing good work, but also, doing your clients right. And so it's kind of making sure you leverage that. And I think that's one of the beauty of the things of this course is, like with the Facebook group and other stuff, you can ask questions, seek for help, or, ask Andy like I did this week. Hey, who is that? I know you've mentioned it before, or even if I didn't know you mentioned it before, say, hey, do you know of anyone that, has specialty in casualty theft and losses or whatever it may be, there, and it's just helpful to have that sort of resource. And I think it's also useful, like, the one firm in town I consider to be our competitor, one of the partners and I will have lunch, I don't know, once or twice a year together and just talk about stuff and, challenges they're having or what they're seeing and things along those lines. And it's just, I'm not getting into details or revealing my inner workings, but just kind of, seeing, all right, have you also decided to do less individual tax return work? And basically both of us have. And, at this point on my end, we're telling people that are calling in new individuals, if they don't have, rental properties or a Schedule C or something with it, or a business with it, then we're not taking them on as new clients at this point. And it's interesting to hear that they're basically at that same point as well. So it lets me know they see the same value and have the same pain points that we do have, from just a firm operation perspective.
Yeah, and definitely, you guys. I mean, one of the things I've gotten to know, from being able to work with Adam, work with a couple other course co-creators, is just your network really is your net worth. And so, if you're leveling up your network and you're getting good people involved with with your career and being a good person for other people, then I really think that's a big part of providing value to business owners. And I would say for those specialized situations, especially if it's a big transaction like Debbie's talking about, probably is a significant amount of money involved. Um, to talk to the client ahead of time about the fact that you're going to work with a specialist and portray it in a way that shows the client, like, this is the kind of network that I have, that I can actually reach out to a specialist, not have it be about my ego, but actually just have it be, about getting you the best result, and probably give them a heads up too, that there's going to be a cost associated with that, so that you're not taking the, paying somebody and it's coming out of your pocket. And I think most clients, whenever I've done that, have been very happy to hear that. So it is something that I recommend.
And Andy, I can even give you another example, like specific, not just this casualty theft and loss thing, but with one of our clients, it's a large Amazon seller. They've had a lot of concerns about state income tax nexus, franchise tax nexus.
Yep.
As it pertains to states are now going after that, now that they've successfully tackled sales tax via Quill. I started working through some and doing an assessment for a client of, hey, here's what states you should consider. And I just did not feel comfortable that I had all the bases covered and that I would be giving them the best results. And so again, I found another CPA that specializes in that area and engage them on a consulting basis with the client's consent. And I think all parties involved were happy with the results.
All right, guys. So I see some good questions coming in on the chat here, and don't worry, we will mark in those right now. So I promise we'll get to those. I wanted to make sure that we address the ones that came in on the group too, like Nancy has been such a great member for us, and I promised I'd get her an answer to this one. It's actually pretty common. Just got books for an S corp, no officer W-2s. Oh, we've never seen that before. What steps to take now? Can they still file timely today? I guess she's talking about filing the W-2s today, because today is the last day to send it to the IRS. Well, I'm sure you've seen that situation before, Adam. Can you comment as much as you can on that?
So I'll tell you where and how we start with that. So one, and the main concern here is, do they have a profitable S corporation that they're taking money out of? Then they should have a reasonable salary as far as the owners, if they're actively participating in that thing. So first we look at, have they taken any distributions? If they haven't taken any distributions or money out, then there's really not, from our perspective or the way we approach it, there's really not an issue, because they don't have to have had a reasonable salary if they didn't take any money out. Now that's fairly uncommon. So then you get to the point, well, they took money out. The way we will approach it pretty consistently with people, and the issue with is, if you go and file those W-2s timely, now you're probably going to get hit with late penalty deposits for the taxes associated with payroll, because those most likely were needed to be deposited previously, and potentially late filings of the 941 and a 940 or whatever there may be there. What we will do oftentimes from the federal side, and everyone has a side if this is the approach they're going to take, but we will do a 1099 and trigger at least the FICA tax that way, to the basis, to the amount of their reasonable salary. And then if they ever get audited or have an issue with that, really, there's the only real exposure I think they have is, I guess the state unemployment taxes and things like that that might have been paid on wages that wouldn't be paid on a 1099. But that's kind of the conclusion or spot we've gotten where we approach it here at my firm. And I'm sure probably most people, probably approach it more of, hey, don't do this again. You have audit exposure here. And unfortunately, a lot of times with this people, they then repeat the same thing the subsequent year, but maybe not.
Yeah, that may depend on the level of communication that takes place. And I would say about this, it's definitely a very common issue. So it's something that's a common problem or challenge, however you want to say it, which to me always means it's a prime opportunity. So I think it's a really good opportunity for you, Nancy, and also anybody else that sees this common situation. There's a lot of nuance to what Adam just discussed. So if you guys have further questions about it, I think it is a little bit of it's an advanced topic, but it's something that's very real and that you'll see. And it's all about, being able to pay that self, payroll tax, self-employment tax, whatever the tax is on the labor element in a justifiable way. And also explain to the business owner that, you have a corporation now. You're not. This is not just do whatever you want and do things however you want. And there is some red tape that you got to be aware of, and just trying to get them to do it correctly the next time. So if you hear this answer, Nancy, and you're like, this isn't specific enough for me, make sure to reach out either via email or post again in the group about very specific parts of the situation, like how profitable is the company? Do they have distributions out, like Adam talked about? But hopefully that answer is kind of a starting point for you. And I think it's definitely a good opportunity for you to, have value for the client. So I wanted to jump in to a couple questions that came in on the chat here, Adam. I know that we addressed this pretty comprehensively in the previous live training, but one of our best members, Michael Dake, had a question about, can a landlord who's a passive rental income, so has a property manager on a K1 qualify for the qualified business income deduction? I'm telling you, I can't, it's like a brain teaser, man.
Yeah, I mean, I guess it's going to depend on how the tax software processes it, but for us in Drake, so if when we're issuing a K1 for someone or someone is receiving a K1, with our K1 that we're issuing, I'm just trying to STB and what their qualifying business income was, what the W-2 wages were, if that applies. And then on the individual side, when we do data entry of the K1 itself, we have spots to enter the qualifying business income deduction information that's provided via that K1 if appropriate. So I don't know if that answered the general overall question, but yeah, there's
this income qualifies as qualified business income. And so you're going to have an input, Mike, on, I think Mike uses Drake, if I'm not mistaken, but you're going to have a input on your software, on your individual tax software, on the K1 screen, where you'll need to check off, that it does qualify, as long as you sort of agree, and however you go about verifying that on your side, that it is qualified business income. And at that point, once you key that in on your 1040 software, it should give the QBI deduction and count it as qualified business income. So it's kind of an interplay between, the document that you get, the source document, the K1, and just making sure that the inputs and also the outputs on your own software. And so test it out a little bit. We even have some other training too. If you hit me up on email, Michael, or post in the group, I think I have another a little bit more training on that I could probably send you. But most times we've been seeing the rental income be treated as QBI eligible, even if it has a property manager. So remember, it's not the same as like the active passive rules. It's not the same. and generally have been seeing that be acceptable for the QBI deduction. Does that sound about right to you, Adam?
Yeah, yeah. It's been fun.
I like the positive attitude. It's all home free from here. It's all downhill from here. So Tiffany says, I told you, Tiffany, no smart people questions, but it sounds again that you're so for cost basis for land or building that someone inherited overseas, if they did not get a basis when they first inherited, would the next best thing to get an appraiser ASAP once they realize they need a basis? So that's kind of on that same thing that we're definitely seeing more of, basis issues and people leaving property behind, passing away and that. So say somebody does not have, a basis, do you guys generally recommend that they would get an appraisal now, kind of as of that time, or how would you recommend to handle that?
Yeah, I mean, I think if they can get a appraisal, so say they inherited the property on like January 1st, 2010. I don't know, this isn't always necessarily possible, but if they can get an appraisal of what that value was at that time, that may be helpful. If they're only able to get a value of what the property is worth at this time, I think that's just kind of maybe not the best use of spending of money to get that, or funds.
Right.
And I'd say more common than not, at least where I see it, Andy, is like, is going to be with real estate that's passed between, and they just don't realize it should be. And I don't know, if nothing else, if there's nothing else to go on, trying to at least look at through county tax records what the value of the property was at that time, and trying to figure in and back into something we can justify to at least get them some sort of value. And with that latter scenario where it's maybe not as clear, there wasn't a formal appraisal, is being conservative on the value versus being overly aggressive when you maybe are lacking some of the backup that they may need to justify it.
Yeah, so in other words, being able to get to, as accurate of a value as you can, but considering the financial circumstances of the person, sometimes those appraisals and those specialized type of backwards looking things can get very expensive. So I think, part of caring about your clients is just understanding what financial position they're in now, how much does it impact the tax either way, and just being as a great professional, like I know Tiffany, already is. Okay, I see a couple people dropping sound. Try reconnecting, you guys. I know the software is not perfect. It's been better for us lately, but if you lose sound, just try reconnecting. Randall has a question here. I do want to move to a couple other things we're going to address. I know this is a fundamental question. I'm just completing my first Schedule C. So first of all, that's awesome. Am I right to say that the self-employment tax is calculated prior to applying the 199A deduction? Yes, you're right. So the 199A deduction is not a deduction against self-employment tax. And you'll see that when you read through the forms. Okay, so I wanted to see, we had Adam, a lot of times at the risk of generalizing, when the clients bring in the QuickBooks, and I'm glad we have Victoria on because Victoria's experienced bookkeeper and accountant. The condition of the records is not, say, the best thing that you would ever see in terms of the QuickBooks. I know, Adam, that you guys have to maintain that balance, leading a team between digging in yourself to all of that QuickBooks fine tuning or cleaning up messed up books and all that kinds of things. First of all, on a practice level with your team, how do you handle that balance, specifically with QuickBooks sort of messes, you could call it?
Yeah, it can get challenging as far as determining, and you have to be careful. There's some work you're always going to have to do in the function of preparing a tax return. There's other work that if they really didn't keep books or records for the year, then you're really creating a year worth of the financial records for them. So that's obviously additional scope of work. And then there's just, additional cleanup. So, and when we do everything on fixed price, it's like, got to make sure that you're not doing all this additional work as part of tax prep that maybe isn't tax prep. And sometimes the answer for us is like, because, while we do some of that stuff, we don't focus on bookkeeping. Sometimes we'll be like, you really need to go, this bookkeeper will clean you up. And once they're done with you, we can, wrap up your tax return. Or sometimes with those things, you're like, you know what, you're probably not going to get this done now, but if you'll let us extend, we'll clean up your books for you at this cost and then file your tax return. But that's what you need to do to get your tax return filed.
So I guess, first of all, you guys, no matter where you are on the spectrum of doing this kind of work, you're always going to get wrong QuickBooks files all the time. So I guess that was my overall, point, and dealing with that fact. I think for me, at least, not having as much of an accounting background was a very big hurdle for me to kind of figure out, like, okay, well, this tax return is totally diverging from like the person's bookkeeper, because I see a lot of deductions that aren't on the bookkeeping, all those kind of things. So I was just kind of getting Adam's point of view on how they handle that. It sounds like it's definitely a big scope of work issue as far as making sure you as a professional, and also, scope that out properly, and also team up. Like, I know Victoria is on the call right now. A lot of you guys might not know that she's, bookkeeping, accounting expert. So within the group, don't feel shy about connecting with somebody else that's what they do, is clean up the books. I know I just connected with a member the other day that helped me with something like that. So I'd say it's a teamwork opportunity, and but it is definitely something that people will face. I wanted to point out, you guys, because I had prepared this stuff, that QuickBooks Online, has a new function called Overview right here, where it'll actually bring up the most problematic accounts in QuickBooks that are normally wrong. And it actually, before you review a job, you can take a look at this, and it'll tell you, like, if there's a lot of undeposited funds, uncategorized asset. Do you see a lot of problems with these particular accounts, as QuickBooks is saying that there are a lot of issues with it?
Yeah, I mean, uncategorized expenses. A lot of times, one of the most common things we see is like people have not reconciled their accounts, and then it's discussion with them. Do you want to reconcile them? Do you want to pay us to reconcile them? But one way or another, they need to be reconciled before we can prepare the tax return. But yeah, you see a lot of times. Yeah, I'm sure there's a lot of big data and AI probably that goes into what they figured out as most common issues, and looking at it, things to consider here.
Yeah, absolutely. I mean, especially like, say, opening balance equity, right? When you see that on QuickBooks, if you haven't worked with it a lot, just not realizing that that's not necessarily a real number, or it's like something that's being pulled out of the air. And so just being able to get that overview, I think, is helpful. Something that I wanted to point out. Just because I'd already prepared this, I want to make sure we touched on this. A common issue for the S-Corp balance sheets, right, as you guys have probably seen many times, is retained earnings, right, to the $150,000. But for a fact that that's not actually retained earnings, like money, like earnings that were kept in the bank account. And so it's not being squared off against the shareholder distributions at the end of the year. Is that something that you guys see pretty frequently, Adam?
Yeah. Yep. And and basically, I guess, kind of state another way of closing out retained earnings for the time period or whatever.
Yeah. So like, if you come to the end of the year, right, and you have $100,000 profit, QuickBooks is not gonna close that retained earnings against the amount of that profit that was taken out. So we could probably do some additional training on that to get it a little more detailed, but it's definitely a big red flag. Or is it more like a common issue, I could say. And can be addressed through a journal entry. So I just put this up here for you guys so you can kind of see a couple things. I spent a lot of time preparing that, so I was like, let me get to this before we have the hour up. But is making these journal entries, is that an important part of like what you guys do as a CPA firm, Adam?
Yep, and it's part of the thing I love about the cloud-based accounting software versus desktop, because if you're cloud-based, you can actually generally make the journal entries yourself in their books, and they're going to be in there, and they're going to be there next year when you come back to it, especially if you lock it down to where they can't make changes beyond that. But you have to have that discussion with them if that's okay. But like with the desktop version of software, I'd say 99 times out of 100, you come back the next year and they haven't made the journal entry updates that you provided to them.
Yeah, for sure. And actually, for me, I no longer deal at all with any QuickBooks desktop whatsoever, because it's just not an effective use of time. And
you're dealing with files coming to and from QuickBooks or Intuit, like sticks it to you if you want to access an accountant version, and just there's no reason, even though we did have to buy the 2019 version of something for a couple clients, but continuing to have those discussions with them if they need to be in the cloud. Unless they need like an enterprise version or something, or maybe they can't get the support they need from the online product.
Yeah, and again, with those kind of things, you guys feel free to connect with Victoria. I know Carlos Preciado in the program does a lot of bookkeeping and accounting too. So, and we can probably do some more stuff on this as well, but I wanted to touch on it. Carlos has a good question here. I know we're running up on the hour here, so we'll but I think Carlos has a really good question about an S Corp loan. So S Corp shareholder loans money to S Corporation, wants to be paid back with interest. How would we treat that from a bookkeeping and tax ramification?
So the way we approach it is, if the shareholder loan is more than $10,000, then interest needs to be imputed and calculated and generally added to the loan balance. We will typically, use the IRS, I think it's IFR rate. I can't remember off the top of my head, but use that rate for the interest rate. I would add, I don't know, we were looking at something this week, I think literally this week or last week, and basically, one of the areas that it said the IRS is going to be looking more closely at in the coming year is just shareholder loans, or people taking distributions in excess of basis, and if they're reflected as loans, are they truly loans? So one other thing we're doing this year is just telling people that if they are doing those shareholder loans, they really need to do some sort of documented note to just kind of get things more in order.
Yeah, and if you're up for it, Carlos, I want to make sure we have Adam just exactly at the hour that he's already committed. So I'll touch on a couple things after we finish up, but I know Adam wanted to touch on as well, just briefly before we go here, something that's actually a really good credit that doesn't get on a lot of people's radar, and that's the research and development credit. Had a point here of this little screenshot is a software that I actually created for our tax office that gives kind of some key performance indicators for, this is like one of our team members. So I actually spent a lot of money developing this, and the R&D credit is something that I was looking into as far as internal software development. I know you have clients, Adam, that as well are in an innovative space or doing something innovative. How does the R&D credit work, and why do we need to keep it in mind?
Yeah. So, and the interesting thing, at least they added it in the last year or two, probably two. It used to be that you had to have profit or tax to take the credit against, but they've adjusted it so that startups, if they have this credit, they can apply it against their payroll tax obligations. So that makes it just much more attractive to a broader use of clients. But it's basically the process in general, is working through expenses and seeing what's allocated to what could be R&D type activities and calculating a credit versus that. There's a simplified method, and I believe there's a non-simplified method of doing the calculation. We ourselves have kind of worked out at least a general framework and spreadsheet that we use for it. And then, as far as doing the credit itself, it's only one form, but you just never know how much you're going to have to go through, or if you're helping them enter that information or get that information to their payroll provider if they need to go that route for the credit. We'll generally charge like a minimum of $12.50 for the credit for calculating and including the credit on the tax return.
Yeah, and I think something we've learned with this credit is like I previously thought that it was only kind of for scientific, development or something, but the definition of those research expenses actually can be, developing internal software. There's other things that can count towards it. So when you're looking at a profit and loss statement, and all this investment that's gone in by a business, there is this credit out there that actually be quite powerful, but it depends how you categorize those expenses and whether it would fit into, possibly qualifying for this credit. So, and that's kind of a pro level tip for you guys that, we hope you'll keep in mind.
For sure.
So I got to the end of I wanted to try to get some visuals going here, because it's visual.
They kept my tired attention with the
right
visuals. So if no one else did, I at least appreciated it.
Yeah, well, right, that means something. That still means something. So, all right, you guys, I'm going to stay on for a few more minutes to address. I see some other questions that are coming in. I want to make sure that, this is a great use of your guys' time. And also just say thanks to Adam, as always, for taking an hour out of his busy week to get this in. I guess we're coming into the busiest time, right? And March is going to be pretty intense.
Yep, it is. I'm going to go grab myself some caffeine and come sit back at my desk. So.
Right on. So yeah, absolutely. Let's still enjoy life. Let's enjoy helping clients, and I'll stay on for a few minutes more with you guys. Adam, have a great day.
All right. Thank you, guys.
Okay, cool. Thanks, you guys, for so many good questions. I feel like this is trying to get better every session with these, and a lot of that comes from you guys, asking good questions. And I wanted to touch back on Carlos's question about the S corp loan. That's it is fairly common, if the money company needs more money, but they don't want to change the percentages of ownership, so like purchase more stock. One shareholder might give a loan, so that would be put onto the books as a loan, so as a shareholder loan, and it goes on the balance sheet of the tax return in the same way. And I would definitely recommend that loan should be documented, like Adam said. Even if it's just a short, like promissory note, this much is lent at this much interest rate, and then when the company is paying it back, right, it's going to be, it's going to be retiring that shareholder loan or paying down that shareholder loan. So just like it would pay down any other liability, like a credit card debt, it's going to decrease the balance, for the company. So definitely needs to be handled thoughtfully, you could say, because some of those loans, like they never get paid back, or they start like disappearing, and they're really disguised distributions, and that's something that the IRS does look at as far as audits. So if you have further questions about that, Carlos, feel free to follow up with us, but hopefully that is helpful to you. Also, On had another good question. Been trying to condense the new QBI law into a shorter, more understandable list. Is there kind of a short list or a short flow chart? So actually there is a nice flow chart on that I found that I like, which is the one I just posted in the chat right there. That's my favorite flow chart that I found. At the bottom of that page. It's from Intuit. So I would check that out. It's a really good kind of simplified, explanation of QBI in a flowchart form. So hopefully that's helpful to you. Victoria said, yes, that's correct about the loan. And that might be an example, right, that you guys might reach out to Victoria, with her QuickBooks expertise. And this is something that she's seen and, been able to handle or even resolve, right, if somebody else didn't handle it properly. So again, I just want to make sure we're working as a team, and, respecting people's different skills is always good, it's part of what makes this program fun. So I hope we continue to build that. Charlene's, hey, Charlene, how you doing? Andy, what's the ACA thing you're referring to that Adam and team are doing amendments to? That is, let me get back to if you're looking for something to Google, it would be this right here, ACA ISRP 2016-17 amendments. So long story short, you can catch the replay to kind of see Adam get a little more detailed on it, but people that paid the ACA penalty, the no insurance penalty for 2016 and 17, if they were in a county with only one insurance company, there's a practice now of being able to only one health insurance option, being able to go back and amend, and because they only had one health insurance option, be able to get out of and recover back that penalty. So I know Adam had ran a report in his software. It might be something that you reach out to people in your local area if you know that your county would qualify for that. And we could probably follow that up too in the Facebook group as well, you guys. Tiffany says, I just tested a client with his prior data to check out the QBI deduction. Yay. We'll learn how the software calculated the UBIA unadjusted basis immediately after acquisition. So I'm glad you're excited about that. I get excited about that kind of stuff too. I'm like, yes, UBIA, so very cool. Maybe Tiffany too, you could post in the Facebook group kind of a little more details about why you were excited about that, or kind of what we should look out for that. So I think you have a good point there. Charlene says, can I change my company name? If so, will it be a DBA, or is there something that I need to do? So if you have an LLC, Charlene, you can, or a corporation, you can certainly change that name. You just have to do that through the, should be the Secretary of State. And you'd have to update your name then, with, like, say, if you have a business license, or, with vendors and all that kind of stuff. If you're a sole proprietorship, you could either file an additional DBA or look at amending an existing DBA if you wanted to change your name. And maybe let us know, in the group, what's your name, what you change your name to. Always feel free to get some feedback. Personally, that branding side of it is always important. Victoria says, all my clients use QBDT, so QuickBooks Desktop. Even though I'm certified in QuickBooks Online, my clients want me to use the portal for QBDT and not online. So I know that is a thing. There are definitely clients who don't want all their financial data online, and I certainly respect that. It's just, for me personally, I'm not a QuickBooks wizard like you. So, but I think that's a good value proposition, right? Is some clients are like that. They want that desktop where they have a little more control over their data, and it's not being crawled over by all the same robots, although it's hard to tell these days, So I think that's a good niche, right? That might be something that you would market to those clients who prefer that, and just your facility with it, your efficiency with it, it makes it a good fit for you. For me personally, I didn't, I'm not at your level on that stuff. So for me, I just don't. It's not a good fit for me. But it would be a good fit for me if, we have a client that wants to do that, to, be able to connect with you on it. So again, just trying to look for that teamwork aspect. Let's see, Carlos's question, got to that. Let's see. All right, Victoria says, just finished 2018 payroll for a company, issued all W-2, all federal and state forms, and mailed everything for signatures and payments. Gave him the approximate amount of penalties for not filing on time. So yeah, this is today, when we're originally broadcasting this, is the last day. You're supposed to be sending this stuff, the W-2s, to the Internal Revenue Service. So, reality being what it is, that's not always happening. So just being proactive about communicating about what those penalties might be. If it's a first time offense, they do have that first time penalty abatement. So make sure you guys kind of keep that in mind to address some of the penalties. And, anytime you can get a penalty abated, it's actually a good service in and of itself. And it's actually a very profitable service. We generally will charge like between $500 to $750 for doing those abatements. And they're actually pretty straightforward a lot of times, but a lot of value for the client. So, all right, I'm sure that was a lot of information. that came at people. Thank you guys for the great questions. And I'm going to try to continue to, bring some visuals as much as possible, you guys, to the live Q&A, just so we have some stuff to look at and learn from. So let me know, give me some feedback as well if that's helpful, or if you prefer to see the talking heads. And always looking for your guys' feedback as far as what works best for you, what gives you the best learning experience. So, all right. Don't forget to also go out and do sales and marketing activities to acquire clients. So if you don't have as many clients right now as you want to have, or you have more, room to help clients, the thing that's going to put that dynamic in your favor, right, is getting outside of your comfort zone, attending a networking event, reaching out to somebody in a Facebook group directly, and looking to see what people need help with. You're happy with your current solution. Why are you happy with it? You're not happy with your current solution. Why are you not happy? Would you give me a chance to take care of you this year and show you what I could do? So making offers, building rapport with people, putting yourself out there. Those are the things that we need to do to actually acquire business. And we're going to be putting together a training and a tax preparer teamwork group that you guys should keep an eye out. And I'll also cross-post that, you guys, to the Business Tax Verified group, but about how to actually get clients. Okay? I see a lot of tax professionals that are relying on the old school way of, well, everybody needs to do taxes, right? I've been saying for like 2 years, you guys, that's totally dead. Like that mentality is just not working at all. And so now we're seeing, with all this competition, all of TurboTax, great marketing on the TurboTax Live. Like a lot of people are saying, oh, it's so bad or whatever. No, it's actually a very good offer, right? Like CPAs on demand, they're very good at selling. So they're very good at selling and we're competing with them. So what does that mean? We need to get better at selling. And selling is not rocket science, right? It's like anybody can do it. It's just about finding people's problems. What about all the problems we just talked about in this recording, right? Like my books aren't cleaned up. I haven't reconciled my bank accounts. I'm not aware of the credits that I might be able to get. So just finding those problems, connecting with people, talking to people, putting yourself out there. If you're uncomfortable, you're probably growing. So just being active about sales, you guys. I really want to see people continuing to build your earning power, and being active about sales, about putting yourself out there is going to be the number one thing you can do. So just do it. Sometimes it's painful, sometimes it's awkward, but if you do it consistently, you're going to see results. And at least in this program, you guys have the backup to be able to take in work, and we want to actively help you, be successful in building this part of your business. So that's my pep talk for the day. I like to give myself pep talks too. It's like, get out there, Andy, and sell and try to help out clients, right? Even if you don't feel like it. So sometimes when I give myself a pep talk, I just want to kind of give you guys one too. And I just encourage you, man. I believe in everybody that's on this call and what we can do, working together. So appreciate you guys as always, and just have an awesome rest of your day. All the best.